So we'll discuss some of the impacts of the COVID pandemic on equity markets, and in particular equity factors. And I think it's interesting to go back to this time of the global outbreak of COVID-19. And you had lots of claims back then about things have fundamentally changed. So if you actually go back to say what you were doing in April 2020, so probably you were sitting at home, probably you were reading the news, and the news were not just about the crisis, but also they were already then a lot about the post-COVID world and what will be the world after the crisis. And again, you saw lots of claims about bold change that would occur, fundamental change. So we would be much more aggressive at tackling climate change because we have learned how vulnerable we are. People would completely change their behavior, and they would even adopt hygiene measures. So COVID will be gone, but people will still be adopting these hygiene measures because they've just learned that they need to be more considerate with vulnerable people. We have learned that we're all really interconnected. We have the same problems, so there will be much better international cooperation. These were like some of the claims that you would hear. Now, this is only about 2 years ago, but it seems that maybe this fundamental change has not really happened in the way that people predicted. And I think the same applies to equity investing and factors. So you had heard, very bold claims during the year 2020. The traditional equity style factors, they are now dead. Clearly with this, change on financial markets, the impact on the pandemic, we actually need to be looking for different kinds of factors, and the equity style factors, in a sense, had stopped working and will not work in the post-COVID world. So these were some of the claims that we heard then, and so we're going to argue here that, well, no, fundamentally, there isn't a change to this kind of factors that investors should be using. Of course, there's some economic mechanisms that played out during the COVID crisis that affected, of course, factors and how they affected factors and what exactly has affected the performance of factors during and after these COVID crisis. That's exactly the kind of question that we want to address. So what I'll do is I'll just start really by the principles of factor investing, just to set the stage, and then we'll go into a more detailed analysis. So, we should really start with what is the promise of factor investing. When you hear claims that factors have stopped working, it's probably good to define what does it mean that a factor is working in the first place, right? So what is kind of the evidence and the theory behind this, and what is actually a factor that works? And there's a few points that are listed here. So basically, the idea behind these equity style factors is that they do deliver, better long-term returns compared to, for example, investing in cap-weighted indices. And there's actually a very low number of rewarded factors that have been validated in research. So there's both empirical evidence behind these factors, but there's also theory behind these factors, and the evidence spans across different markets, across different asset classes. It's typically quite long-term evidence. The theory really is this economic theory that basically you can get exposure to assets that actually have losses during bad times. So when typically consumption is low, marginal utility of consumption is high. So if you have assets that have losses in these bad times, you want to be compensated for that on average, right? So you're going to have losses in bad times, but you get this compensation on average over long periods. Over shorter periods, of course, factor premia have a lot of variation. So this is also called cyclicality of factor premia. So different factors have different dependency on macro conditions, and this is precisely why people use multi-factor indices. So multi-factor indices will actually smooth some of this outperformance, but keep in mind that these factors are basically have a risk-based rationale, so they will still be risky even if you combine several factors. So what happened during the time of the COVID outbreak? So as I mentioned, there was lots of claims that factors had actually stopped working in 2020. And clearly, we've seen, and we're going to see that important losses and drawdowns during the COVID crisis. Of course, the COVID pandemic had a fundamental impact on markets during that time. So, if you go back to 2020, you basically had the first lockdowns in Italy in February of 2020. There were severe consequences of this on stock market returns. Then in March 2020, you had the announcement of US stimulus, and that kind of led to a, let's say, more positive reaction of stock markets. And this played out even, further on. So, for example, in November 2020, you had this announcement of a highly effective vaccine against COVID, and that completely changed the picture on kind of how how different sectors will actually perform. So this COVID crisis led to not just an aggregate impact, so basically a decline in stock returns and in broad cap-weighted indices, but above all, it had an impact in the cross-section of stock. So clearly you had winners and losers on a relative basis from this new environment, from these pandemic restrictions in particular. And so what you've seen is that in particular certain sectors had actually very strong outperformance or underperformance to the market. Obviously, you had the strong impact on the market itself. And so if you think about this kind of market setting where you have very strong movements in the aggregate market index, but also you have these heterogeneity across different sectors, you would actually expect that a lot of the returns in a portfolio will be driven by the exposure to the market and by the exposure to different sectors. And actually factor strategies are no different from that. So both, even small differences in market beta and even relatively small differences in sector exposures, had led to very substantial differences in returns for factor strategies. And this, of course, is something that it's not necessarily directly related to factors, but a lot of this variation is just related to other types of risks that factor strategies may be taking on. For example, being either slightly defensive or slightly offensive in terms of market beta, or having different sector allocations. So we had a big role for these unrewarded risks. But beyond just the role of these unrewarded risks, it's interesting also to think about the factor premia themselves. And here, what's important to note is really, let's go back to this economic rationale of factors. Okay, so why should actually investors be rewarded in the long term just by being exposed to value stocks, just by being exposed to the size factor, or just by being exposed to quality stocks, for example? And the idea behind this clearly is that there is a premium behind these factors. Now, there's really no reason why this premium should be delivered every year. So this goes back to the question of what is actually a factor that works. So the answer to that question is not, a factor that works delivers positive returns every year, right? So clearly, these factors deliver returns precisely because they're exposed to some systematic risks. And so you would actually expect that in certain economic conditions, they will actually have losses. And so this is very different from this idea of alpha. And I think the industry here has, led to some false expectations among investors by saying that, factor investing just kind of gives you cheap alpha. So, just how active managers can pick, good stocks and undervalued stocks. Well, factors, that's just the same. So the value factor is about finding undervalued stocks that generate some alpha. And this is, of course, not what kind of the value factor is in a way designed to do. That's not what the evidence about the value factor says. And so you cannot expect to get, kind of alpha from multi-factor strategies. Instead, what you get is you're getting exposure to risk. So these are kind of new sources of risk in addition to just the kind of the equity market risk exposure to the broad market factors. And so you're getting compensated for actually bearing these risks. And so that's a point that is very important to keep in mind, that these factor premium, they actually reward for bearing risk. And if you look at the economic mechanisms behind that reward and kind of what these risks look like, you would actually expect in many cases that in an economic environment like during 2020, you would actually see losses in these strategies. So just take the value factor as an example. So the value factor is typically explained by this effect of costly reversibility of assets in place. So the idea is that value firms typically tend to have lots of assets in place. So they have very little flexibility, actually, if you will, to adopt if there is a shock to the economy, to the aggregate economy, right? So if they have to adapt to a setting where their output is actually much less in demand, well, they can actually not adapt, if you will, their capital stock to this setting, and so they will actually, directly bear these losses of reduced economic activity. It's very different for growth firms. So growth firms, typically their value is made up not by the assets in place, their value is made up by the options that they have to actually grow and develop business in the future. So if there's actually an economic crisis, growth stocks will actually be able to kind of postpone the exercise of their growth options, and so will be much less affected by these kind of crises. So kind of another way of looking at that also, there's some academic evidence, linking these factor returns to what is called cash flow duration, right? So you have a lot of these factor premia, they're related to firms with actually lower cash flow duration. So since they have these cash flows in the near term, of course, this kind of crisis was much more damaging to them, right? So if I have most of my cash flows occurring in the next 2 years, then the lockdowns, the reduced activity will actually be very costly for me. If I'm just basically can continue to invest in research and development and just kind of delay the exercise of my growth options, I'm actually less affected by this crisis. And so it actually, if you, were to ask someone at the end of 2019, which stocks do you think would suffer from this kind of crisis? The most obvious answer would probably be value stocks because of the economic mechanism behind, their premium. And so clearly, you could say that some level of loss in these conditions would actually be expected. Now, another important point is that, of course, multi-factor strategies are not all the same. So there's lots of design choices that go into these multi-factor strategies. Of course, first of all, you need to actually look at a set of factors, kind of a menu of factors that you select. And the clear recommendation here from, I think, replication studies of findings on different factors is clearly you should rely on, factors that are quite robust, that have been replicated independently. Because, it's actually easy to make up some new factors from backtests, but those backtests quite often, as we know, do not actually survive scrutiny and do not actually survive the kind of, testing and replication that has been applied to the kind of the workhorse factors, like the book to market factor for value, like the standard momentum factor, and these types of factors. But of course, selecting the right factors doesn't actually give you full answers, because you still have to think about diversification of stock specific risk, right? So if you want to be exposed to, let's say, the value factor, is not a reasonable strategy to just select one stock that has the highest exposure to value. That seems like an obvious statement, but of course behind that, what it ultimately means is you actually have to, think about how do you diversify idiosyncratic risk. And of course, we know that there's, a bunch of portfolio construction approaches that we know in finance, which can actually help to, use information on correlation across stocks and then come up with a well-diversified portfolio. Of course, you can smooth out some of the, risk related to factors by combining them. So you can build on the cyclicality in a multi-factor strategy. And finally, what a multi-factor strategy should also incorporate is these kind of position yourself on these short-term risks, on these unrewarded risks. So I mentioned a role of sector risk during the COVID crisis. So clearly, investors should be aware of that, and they should make an explicit choice in their multi-factor strategy on how do they want to be positioned in terms of sectors. Do they want to accept the implicit tilts, or do they want to do something about them? Do they want to accept the market beta decisions also of a factor index? So if you have factors like the low vol factor, the quality factor, these tend to give you lower market beta. So is that something that you want to correct, or is it something that you want to accept? So that's really what kind of these are the key decisions in really the design of multi-factor strategies. And what we'll show here is what is actually the impact also of these different decisions on performance in the short term of different multi-factor strategies. So what we're going to do is basically first we're just going to analyze drivers of performance of these factors over this short period. And so that's going to be the first part of the presentation. And then the second part, we will focus on one of these factors that has been debated very extensively. So that's the value factor. And there's lots of, I think, interesting insights you can have from analyzing the recent period about the value factor. So with that, let me hand over to Danielle for the drivers of performance.
Thank you, Felix. So the objective of this first section is to answer to the question, can factor investing still deliver on its promise? And so what I'm going to cover is the drivers of performance of factor strategies. And the first one is obviously the performance of rewarded factors. So to do that, we look at long-short factors, which are the kind of pure risk-rewarded factors that you try to get exposed to when you invest in a multi-factor strategy. So the analysis covers the US market. And in the table, we show the 6 consensus rewarded factors: size, value, momentum, low volatility, high profitability, low investment. And on the last column, you have the portfolios, the 6 long-short factors equally weighted, to get an idea of the average performance of these factors. So the first observation we can make is that out of the 6 factors, 4 of them had a strong negative performance in 2020, which was the year when COVID started and we had the most important effects. Value had a negative loss of minus 22.6%, low volatility minus 16%, low investment 16%, and size minus 4.7%. So these performances are really negative. And when you look at an historical sample of more than 45 years, and you try to see if these performances are extreme or not, well, you can see that these performances for most of the 4 factors were extreme. So when you look at the worst 5% 1 year level for the value factor over the last 45 years, this extreme level is minus 19%. So the performance of value was extreme in 2020. We can say the same for low volatility and no investment. If we look at momentum and high profitability, well, they benefited from the crisis. They had positive performance, plus 13% for momentum, 11% for high profitability. So these performances are not extreme compared to historical level, but they are positive. So finally, if you look at this portfolio of long-short factors to assess what happened to the average factors, you see that the performance in 2020 was negative, minus 5.5%. So again, you can think that minus 5% is low and is not very dramatic. But when you look at the historical distribution of the worst 5% 1 year return for this portfolio of the 6 factors, well, you see that the minus 5% are extreme. Okay, so this is the first maybe takeaway of this webinar for the performance of long-short factors. The performance in 2020 was extreme compared to historical standards. Now the question is, what happened next? So what happened in 21 and 22? So if we look at the 4 factors that had negative performance in 2020, they all rebounded. The most important rebound is value, with 8% in 21 and 12.5% in 22, followed by low investments and low volatility and size, which has also positive performance in 21 and 22. When you look at the 2 other factors, momentum and high profitability, you see that momentum crashed in 21, minus 22%, which is compared to historical standard, which is extreme. and then slightly recovered in 22, and high profitability at a flat year in 21, and negative performance of minus 10% in 22. And when we look at the average performance of these 6 factors in 21 and 22, you see that they rebounded and they recovered the loss that they had in 2020. So this is maybe the second takeaway of this webinar. Yes, factors had a very negative year in 2020, but after that, the average factor performance recovered from the low of the COVID. So now the objective of this next slide is to try to find a common characteristics to explain these strong negative performance that we observed in 2020 and the rebound afterward for some of the factors. And we are going to look at the intangible ratio, or intangibility characteristic, if you want, which we think is very important because the economy has changed compared to 50 years or 60 years ago, where the economy and the growth of the GDP was mainly driven by companies with large plants that were producing goods to generate the revenues. Now, companies are generating revenues with intellectual property, with research and development. So we are in an immaterial economy, and this notion of intangibility is very important. So we define this intangibility characteristics using a ratio. So we take the total intangible assets of each company divided by the total assets. And the total intangible assets take into account recorded intangible assets that you find in the company's financial statements, plus unrecorded intangible assets that we measure using organizational capital and knowledge capital that Felix will discuss in the second part of the presentation. So once we have this ratio, we can, if you want, rank companies by this ratio, and we can look at the performance of the low intangible companies and the high intangible companies. So we did a long-short portfolio where the long branch is the lowest intangible companies and the short branch is the highest intangible companies. And what you see is that this portfolio was strongly impacted during the COVID. So the months that followed the first cases and the first lockdowns, so in February, March, the underperformance was close to 20%, which is huge. And then the underperformance continued through 2020 to reach almost 30% of underperformance. And then you had a slight recovery in 21 that accelerated in 2022. So the question is, can we link this long-short intangible and these intangible characteristics with long-short factors? So the first thing we did is to look at the correlation between long-short factors and this long-short intangible portfolio over the long term. And what you see clearly is that value and high profitability factors are strongly correlated with this intangibility characteristic. For value, I mean, the positive correlation makes sense in the sense that you select value stocks are high book to price companies that tend to have high tangible assets and low intangible assets. So this is not surprising. And if you think of high profitability, well, when you invest in the high profitability factor, you tend to strongly overweight technology companies, which by definition have stronger IP, intellectual property, or research and development. So these are companies with higher intangible assets. So these results are long-term. And if you look at the other factors, size, momentum, low volatility, or low investment, you cannot really say something about if they are linked or not to this intangibility characteristics. So what we did is to look at factor selections in specific quarters, in particular the first quarter of 2020. We did also an average across all factors over the last 20 years, and also an average across 21 and 22. So what we did here is to measure the overlap between the factor selections. So let's say the small cap companies or large cap companies that you have in the factor size factor with the low intangible portfolio or the high intangible portfolio. And the first observation that we can make is that first we confirm the long-term correlation analysis, in the sense that value and high profitability is the right characteristics. So if you look at value in Q1 2020 or on average over 20 years, you see that the value companies have an overlap of 46% or 47% on average with the low intangible portfolio, which means that almost 50% of the stocks that are value in your long-short value factor are the same as the low intangible portfolio. And the same is true for high profitability companies. You see the overlap on the fifth column. You have 63% of high profitability companies that overlaps the high intangible portfolio. So this is a confirmation of what we observed with the correlation analysis. The interesting point that I want to highlight is what about the other factors? Can we find something common that can explain the losses that we observed or the positive performance for momentum and high profitability? So if you look at the Q1 2020 column, and you look at the 4 factors that underperformed in 2020, so size, value, low volatility, and low investment, the long range of these factors had a higher overlap with the low intangible portfolio than the short range. So I already mentioned that for value, but if you look at the low volatility companies, the overlap was 48% for the long range, so the low volatility companies, and only 18% for the high volatility companies. So this kind of characteristics for low volatility is almost the same as for the value. So we had the same characteristics for all these 4 factors that had a negative performance in 2020. And similarly, or conversely, if you look at momentum and high profitability, both of these factors, they had a stronger overlap in their long range with the high intangible portfolio. 38% for momentum in Q1 2020 and 63% for high profitability. So the conclusion of this first section on equity or long-short factor performance is that intangibility characteristics was very important in explaining the short-term performance of US long-short factors. So typically, companies with high intangible assets were less impacted by lockdown measures and outperformed companies with low intangible assets in 2020. And when you look at the composition of factors in Q1 2020 across 2020, well, all factors that had negative performance had a higher exposure to low intangible companies, and inversely, momentum and profitability that benefited from the COVID had a higher exposure to high intangible companies. And the interesting thing also is that as lockdown measures were removed, we observed a reversal in the performance of low intangible companies that started to outperform high intangible companies. And this can help to explain the rebound of some long-short factors, not all of them, but it clearly explains the recovery of the value factor that happened in 21 and 22. Okay, so this was for the first driver of performance. If we can recap this section, long-short factors in the US had a dramatic year in 2020 with negative loss, but they recovered in 21 and 22 on average. And the very important driver of this short-term variation was this intangibility characteristics. Now, the second driver of performance of factor strategies is the diversification of idiosyncratic risks. So according to modern portfolio theory, you have 2 types of risks. Systematic risks that cannot be diversified, and idiosyncratic risks that you can diversify. And the main takeaway of this theory is that you can maximize the Sharpe ratio of your portfolio by reducing its volatility via the diversification of idiosyncratic risks. So this is typically what we do for multi-factor indices within scientific beta. We rely on diversified weighting schemes. Now, one of the characteristics of diversified weighting schemes is that they are less deconcentrated than cap-weighted benchmark, simply because cap-weighted benchmark are concentrated in the largest capitalization stocks of the universe by default, by definition. So as soon as you are more diversified than a cap-weighted benchmark, you underweight the largest caps and you have a higher deconcentration. So the issue is that when you are more deconcentrated than a cap-weight benchmark, is that if the performance of the cap-weight benchmark is concentrated in the largest caps of the index, then by definition, diversified weighting schemes will be penalized. And this is typically what we show in the table of this slide. We show the excess performance of the 5% largest capitalization stocks over the broad cap-weighted benchmark. And we see that on the US universe in 2020, this outperformance was close to 6%. This is huge. In 21, it was 1.7%. And in 22, there was a recovery or reversal, and largest cap underperformed the benchmark by 3%. But you see that this effect of concentration can be very important and was important on the US universe in 2020. Now, the question is, okay, is this strong concentration of performance something that we should see in the future? The answer is no. If you look at the long term, or more than 45 years, the long-term excess performance of the 5% largest caps is slightly negative compared to the benchmark in all regions. So it means that over the long term, being deconcentrated via diversification strategies should be beneficial. Now, there was another issue during the COVID. The market was completely dislocated. You know that we had to cancel our quarterly review in March 2020 because we had replicators calling us saying, okay, we cannot trade stocks, so please cancel the quarterly review. And so I picked two metrics to highlight this financial stress: the cross-sectional correlation that peaked during the first quarter of 2020, and the cross-sectional dispersion, which measures the dispersion of stock returns each month among the universe. And you see that these two metrics were at extreme levels compared to historical standards. Now, what is the problem of being in a market stress, or when you are in these conditions of market stress? Well, weighting schemes that are diversified, they try to exploit the correlation between stocks. This is typically what we do within scientific beta. Now, during a period of market stress, you will see stocks that will tend to move together. So you will experience an increase in the cross-sectional correlation of stocks. It means that using correlation to try to diversify will be less effective because stocks will tend to move much more in line together than in normal times. The second issue is that when you estimate correlations, when the market is completely in stress and that you have strong dispersion of returns, the correlations are not stable. And so diversification techniques become ineffective. Now, to conclude on this question of diversification, what we can say is that these market stress events are rare. So over the long term, the benefits of diversification of idiosyncratic risk that we find the roots in the modern portfolio theory should be effective again. And there is no reason to believe that it should not work. Okay, the last driver of performance is the impact of non-factor risks. So the non-factor risks are a byproduct of factor strategies design. And the first one is the market beta gap. The market beta gap is simply the difference between the market beta of your factor strategies and the cap-weight index, which is 1. So when your market beta gap is negative, it means that you are slightly defensive, which is the case of many multi-factor indices, because if you are exposed to low volatility factor, you are exposed to low beta stocks. And so on average, I insist on this term average, multi-factor strategies are defensive. Now, what happened during the COVID is that we observed the market beta compression phenomenon that was reported also by other competitors, not only scientific beta, where low beta stocks had a sudden increase of risk, and high beta stocks suddenly became less risky. And so the stability of the market beta, or the market beta gap, was not anymore effective, and we observed a strong instability of the market beta gap, mostly on the US universe. I also showed the developed ex-US universe where this impact was less strong. So it means that this market beta variability can have an impact on the performance of factor strategies. And when you look at the table in this slide, you see that, okay, the impact can be positive or negative. It depends on the market beta gap and the performance of the Caprit benchmark. But what is important for investors is to understand that this market beta gap, which is a kind of implicit non-factor risk, can have a material impact on the short-term performance of multi-factor strategies. And that if they want to control for this risk and to try to reduce it, they need to implement proper risk management techniques, such as a market beta adjustment that we offer on our indices to control for this variability of the market beta. And as soon as you control for it, then its impact is reduced. The other source of non-factor risk is sector risk. So obviously sectors were dramatically impacted by COVID. We see the excess performance of sectors in 2021, 22. We see that the dispersion of performance among the sectors were huge. So the COVID has a very strong impact on the sector excess performance and rotation. So again, if your factor strategy do not control explicitly for the sector risk, it can have a strong impact on the short-term performance of your factor strategies. And because when you invest in multi-factor, you are invested in some factors that have clear sector bets. If you think of the low volatility factor, you have a utilities bet. If you think of the high profitability factor, you have a technology bet. So when you combine in a multi-factor, you have implicit bets, sector bets. And I show in the table that the impact of these bets or sector deviation were strong when you don't take into account the sector neutrality or sector control, were strong during the COVID. And as soon as you control for this sector risk, you can reduce the impact. And so it's very important for investors to understand this sector implicit risk and then to control if they want to control it. Now, an interesting point on sectors is that the sector neutrality were not really effective during the COVID because there was a strong difference or dispersion of excess performance inside sectors, so in subsectors. So, for instance, in cyclical consumers, some subsectors were benefited from the restriction, and some others were negatively impacted. So, sector neutrality was not effective during the COVID. So, we are working with Felix on topic on try to improve the sector control of our indices by asking the question: okay, can we find a common set of risk drivers, one or two, that could explain mostly the sector risk? And if we can find these one or two risk drivers, is it more effective to control for these risk drivers directly than sector neutrality? So I think that this is something that Felix can mention discuss in the first subject of the Q&A, what we try to want to do in the future that might lead to an evolution of our indices. So to conclude, to the question, can factor investing still deliver a promise? You will not be surprised. Yes, factor investing is not dead. The losses that we saw in 2020 are consistent with factor investing rationale. Felix explained that it's normal that you get hit when these additional risks that you take when you get exposed to rewarded factors materialize. And these additional risks clearly materialized during the COVID as for the value factor. So there is no reason to believe that the long-term reward of factors will disappear. Diversification, there is no reason to believe that over the long term, the benefits of diversification will not be valid. And so COVID was an extreme situation, and the benefits of diversification should be valid in the future. And finally, non-factor risks, investors need to be aware that their impact can be on the short-term performance, can be stronger than the contribution of rewarded risk factors themselves. So they need to be aware of that. And if they want to, they need to control for these risks directly. I am done with my section. Felix, I let you continue on the value factor.
Yes, thanks, Danielle, for this. So I will build on some of these results. So what Danielle showed already is you had this very negative performance of -5% across the 6 factors in 2020, but the value factor clearly stood out there as having particularly negative returns over that time period. And of course, the question is, what is the reason for that, and also how is that connected maybe with how you define value? So there has always been, I think, discussion in the industry. It seems like almost everyone has their favorite definition of value, and so I'll try to put some perspective on these questions. So clearly, the value factor is also sometimes called the mother of all factors. So it's one of the factors that has been around for the longest time. There is a pretty clear economic rationale also behind the value factor, basically showing that value stocks are riskier than growth stocks. I already mentioned this. So this simple idea that when you have lots of assets in place and those are actually cost into reverse, you're basically less flexible than growth firms, and so you will be hit much harder by an economic crisis. So in other words, value firms are riskier than growth firms. So this is not just an intuition, so you have kind of full-fledged economic models that actually detail this mechanism and really lay this out in a formal way. But of course, theory is just theory. So what kind of the theory suggests is also that this is all based on book to price, and so that's why book to price is the standard value definition. But still, you're just talking about theory. So there's also a question: well, do we actually see any of this in data on firms? And when I'm talking here about looking at data, I'm not talking about so much looking at directly the performance of value stocks. We know that just looking at performance is something that comes with a lot of measurement error. So depending on the time period that you look at, you could get quite different results, and it doesn't actually tell you anything about the mechanisms. So really interesting question actually for any factor is, do we actually see some evidence that this mechanism that drives the premium is actually at work? For the value factor, there is quite strong evidence in favor of this mechanism. So, in quite a kind of famous example is actually the variation of market betas. So, what would you expect on the variation of market betas? Well, with this mechanism of value firms have lots of assets in place, and so when there's bad economic times, they will actually suffer more. So, what you would expect is that the exposure to the market will actually go up in bad times. And there's, some famous results showing exactly that. So when actually there's bad times, which means that basically the equity premium is high, so investors demand much more compensation for holding equity. Well, in those times, value stocks actually tend to have a larger exposure to the market. So basically by getting these higher exposure to market risk in bad times, that's something that, of course, investors want to be compensated for, and there is, quite substantial evidence that indeed value stocks have this variation in market betas. So this countercyclical variation basically means that betas increase in bad times, and we have substantial evidence for that. So that exactly shows that they're more risky, right? So from an investor's perspective, you don't like that. You don't want to have stocks that have an increase in market beta in bad times. So in the long term, you should get rewarded for that. You can also look at more kind of fundamental measures of risk. So things like earnings cyclicality. So if you, for example, look at how earnings of value firms behave in bad economic times, you can also see that value firms tend to have more distressed earnings in bad economic times. You can also look at things like operating leverage. So you can see in that sense also value stocks are more risky than growth stocks. And so there is not just this theory saying that, oh, these stocks are more risky, but there is actually a lot of evidence that they are more risky, and that kind of explains why in the long term investors should actually see a premium. But again, this is only something that of course happens in the long term. And so the question that arises is, how do you define this value factor? As I mentioned, price to book is really what is closely related to the theory. There have been lots of claims that price to book is now outdated because of the importance of intangible assets. And so clearly, if you go to accounting data and you look up a book value of a stock, there's lots of intangible assets that are basically not in there. So they may have an economic value, but they are ignored by kind of the current accounting standards, right? So basically current accounting standards, they have this bias of being, conservative. And so, accountants have difficulty actually allowing to put a value in a balance sheet on something that is maybe, quite difficult to define. And so, for example, you would have a hard time trying to actually use intangible assets if you're a corporation as collateral, right, for something. So intangible assets come with this challenge, and they're quite often missing from a lot of the accounting analysis. So this has prompted a lot of providers to say, okay, let's not look at book to price, because you have these silly book values with accounting rules that don't make a lot of sense. So why should we actually use that metric? Now you can take a very different standpoint, which is, well, yes, book to price is actually what defines the value factor. This is what is actually kind of shown in the theory to be a metric that then leads to a premium. Now there is a problem with the book value. It's not measured in a good way. So let's just try to improve the measurement of the book value. This is what we have done. So in the Sine beta value indices, we're actually accounting for intangibles in the book value. So we've published a paper basically testing this methodology and showing that this is a credible way to actually measure the value factor. So the idea is to stay with book to price, but simply improve the measurement of the book value. And there's basically two big aspects that are missing in the book value. So there's organization capital and knowledge capital. So these don't appear on balance sheets, but you can actually estimate them from expense items. And this is something that you do find in accounting data, and the techniques here are quite standard. So we haven't invented this. We're actually able to draw on quite a kind of substantial literature showing that, for example, you can estimate knowledge capital from R&D expenses. So you basically add these, you kind of capitalize this and kind of add it as if it was on the balance sheet, and then you amortize over time. And you also do that with part of selling general and administrative expenses, which actually can go into things like training of employees, for example, improving the maybe the kind of the productivity of employees, maybe improving the distribution network, etc. And so this is all summarized in organization capital. Now there's different ways of doing this, but there are quite established methods. Now, after we published our paper on the value factor and kind of accounting for intangibles, there has been, probably at least a handful of papers which do quite similar things. They don't always agree exactly on how you account for this intangible capital, but it turns out that these details actually are not that important. So these adjustments basically produce a kind of more significant value premium, and they are actually totally in line with the rationale of the value factor, because intangible capital also is costed to reverse. And again, there is lots of evidence for that. So if, for example, you invest in R&D, you create this knowledge capital, and then let's say because of hard economic times, if you have financing constraints in a company, you will then actually have to abandon kind of a half-finished R&D project. That actually effectively means that you're facing a loss in these bad times with financing constraints that hit, and that's very similar to what you had with physical capital. So this is how we define value. Again, in the industry, it's been quite popular to say that let's forget about price to book because of all these measurement problems with book. And so there's popular measure like earnings to price, sales to price, cash flow to price, or the dividend yield, and also many other measures, but these are the main ones. And so it's interesting to look at these different ratios. So what we're going to look at here is really how did these actually behave in the short term, and also what are some important differences when you start defining value differently. So here what we're looking at is simply performance over these short periods, so 2020, 2021, and the current year. And you see here this result. So the performance of this value factor is highly negative, about minus 20%, but that's actually true for all of these different value definitions. So in 2020, it didn't actually help to define value differently from price to book. You can then see that value strategies didn't only suffer in 2020, but they actually also had this strong positive returns in 2021, and then also in the first half of 2020. Now, what is the effect, though, that you get when you actually change from book to price and you're actually looking at other valuation ratios? Now, there's a kind of common intuition that somehow this is a good idea because in a way you have some diversification across different ratios. However, what's really important to note is that in a very mechanical way, moving from things like price to book to things like earnings to price actually gives you a lot of a non-value exposure. And so part of the reason why these alternative definitions have become quite popular is simply because the value premium actually was quite low. So value regions were quite low even before the COVID outbreak. And so kind of a good way to do something better than the traditional value premium is actually, well, just call something a value factor, but actually make it value plus another factor. And quite often what people do is they take something that is value plus quality. And of course, in times when value has very low returns, a value strategy that is actually value plus quality will of course look better than just value. And this is actually what's going on behind a lot of these alternative definitions. So you can see this here. For example, if you look at the intangible adjusted book to price, you have very low kind of exposure to other factors like profitability and investment. If, however, you go to definitions like earnings to price, you see strong exposure to these quality factors. So you see very high exposure to the profitability factor in particular. And so this actually gives you, just exposure to other rewarded factors. Of course, the big problem with that is that, you no longer really have a value strategy. And if then in the end, as a multi-factor investor, you're going to combine all of these factors, well, what you think actually is the value factor, it's actually value plus high profitability with these definitions. And so implicitly, you're actually getting some concentration in factors like high profitability, because in a way you have it twice or 1.5 times, because you have it not only in the quality factor, but also in this so-called value factor. Now, this is just a result here. So it's a regression result. So, you could kind of question that. But what's important is that this is actually quite mechanical. So if you think about book to price, right? So high book to price firms are value firms. And now think about earnings to price. So to go from book to price to earnings, you basically multiply that with a measure of profitability, right? So if you take something like earnings divided by the book value, right? This is kind of the tilt that you're getting in addition to book to price. And that's just a profitability measure. So this result that by using earnings to price, you're getting some profitability exposure. It's not just, if you will, a statistical result. It's actually, in a way, a mechanical result just because of focusing on things like earnings relative to price and even cash flow relative to price. You are kind of mechanically giving an advantage to more profitable firms. Now, clearly, this means you're getting exposure to some other factors. So you're no longer talking about just a value factor. You're also getting then, unsurprisingly, big differences in sector exposures, and these ones align very well with the sector exposures of the profitability factors. And so you're basically getting by using these other ratios, you're getting strategies that are not so much value anymore, but they're actually kind of a mix of different factors. Now, when the value factor does make a rebound, as in the current situation, then obviously by having these kind of mixed strategies, you would also expect to profit less from that rebound. This is indeed what we see. So here we compared a scientific beta index, which is quite narrow, so focuses on strong exposure to value. And here again, the value definition is just book to price with the intangible adjustment. And we're comparing that here to a set of competitor strategies that have much more complex value definitions, combining different variables. And you can see here that over the past 3 years, so sticking with price to book and making this intangible adjustment led to about 70 basis points excess return, whereas actually the average competitor index led to a negative 50 basis point of return. And so you see here a difference in the short-term performance. So the conclusion to this basically is, when you tweak factors and kind of try to change the definition, and if that is just in response to short-term returns, you just have to be aware of the fact that you may actually get, a combination of factors, which is quite different from the intended one. So you're getting a lot of implicit risk, and that also means that you would actually then benefit less from a rebound of that particular factor that, in principle, you are targeting. So this is an important conclusion. And then, obviously, if you think back to the kind of the rest of the discussion, the presentation, I think key point that Danielle made is really this importance of non-factor risks. And so clearly, this is something that investors need to keep in mind, that when they actually invest in factor products, a lot of especially the short-term performance, is driven by these other elements that Danielle discussed in detail. And of course, as a final point, as theory suggests, yes, factors are risky. And so that also means, if harvesting factor premia is really something for investors who have an edge in terms of, they have maybe less risk aversion, they have maybe a longer time horizon, and that actually puts them in a position to harvest these factors. And so in this sense, we would conclude that, this COVID crisis just illustrates some of the mechanisms with factor strategies. Clearly, there hasn't been a fundamental change in terms of what the factors are and how they work. So thank you very much for your attention.